Welcome to BEworks webinar on how investors can stay rational in irrational times. I'm David Lewis, the Chief Client Officer for BEworks. So today's topic is how can we help investors avoid poor decisions during a global pandemic? A little more about BEworks. BEworks was founded in 2010. One of the co-founders is Kelly Peters, Chief Executive Officer and co-founder. BEworks is the world's first management consulting firm dedicated to solving complex challenges with behavioral economics. Today we'll be hearing from Dan Ariely. I'll tell you a little bit more about Dan later. He's a professor at Duke University and is a leading academic in the field of behavioral economics. As I said, my name is David Lewis. Also joining us will be Max Thompson. Max has an MBA from Concordia University, is a CFA, and he spent 20 plus years and is a subject matter expert in retail banking and wealth management. So here's a little bit more about Dan. Dan has done groundbreaking experimental research. He's a leading academic, a prolific writer. He's acknowledged as being one of the experts, global experts in behavioral economics. He's been featured in the New York Times, Wall Street Journal, Washington Post, Boston Globe. And he's also written 3 New York Times best-selling books that have become recognized as a standard in the field. Predictably Irrational, The Upside of Irrationality, and The Honest Truth About Dishonesty. I'd encourage you to go out and buy one, and you'll thoroughly enjoy it, and I guarantee you'll then buy the next 2. I have a short video here from Dan. I'm just going to cue that up now, and you'll hear Dan's introduction.
My friends, in these complex times, hi from my kitchen. This is Dan Ariely. I'm the James B. Duke Professor of Psychology and Behavioral Economics and the proud owner of a half a beard. Not because I lost a bet, but because I was badly burned many years ago, and much of my body is covered with scars, including the right side of my face. Okay, but although my scars and burns got me first to think about irrationality of human nature, what's happening now around us is giving me lots of more things to think about in terms of irrationality and human nature. And today I want to talk about one simple topic, which is the connection between anxiety and investment in the stock market. So in my mind, there are 3 types of people as far as the stock market is concerned. The first type are the people who don't think they have any special information about the stock market, but that recognize that. These are the people who don't know much about the market and know that they don't know much about the market. The second type is the type of people who don't know much about the stock market, but think that they know a lot. And the third one is the people who really know a lot about the stock market. And I hope you agree that in that section, in that group, there's very few people. Okay. So now, what should the 3 types of people do? First of all, what is very clear is that people from the first group should not be trading. You don't know anything special, don't take any action. The people who don't know a lot but think that they know should also not do anything because they don't really know. The only people who should make decisions are the people who truly know. But those are very, very few people. Okay, so we said most people like me, for example, shouldn't touch their portfolios. But there's another thing, which is the question, should we look at our portfolio? And the question is, what is the function of looking? The function of looking presumably is to help us make better decisions. The first category of people are not going to make any decisions, so they shouldn't be looking. The second category of people hopefully are not going to make any decisions, so they shouldn't be looking. And the third category of people, the people who know a lot, probably shouldn't be looking either. Why? It turns out that if you want to make a change, it's not about the position of your portfolio. You should say to yourself, I think Zoom is going to go up, or I think Amazon is going to go down, or the other way around. Whatever you think, you should be thinking about it without looking at your portfolio. The particular place where the market is right now is not a good prediction of what will happen in the future. You're thinking to the future, what will happen. Now, imagine I think to myself what will happen, or I first go into my portfolio, I look at it, and then I think to myself, what will happen? Well, going first into my portfolio in these days is going to get me into anxiety. It's going to get me to worry, and mostly to be upset, to get to some emotional state. And that's going to color my decision about moving forward. So, the people who don't know what the market is going to do and recognize it shouldn't make any decision and should look at their portfolio. And the people who don't know what the market will do, but think they know also shouldn't be doing anything and shouldn't be watching. The people who know or have a special information about the stock market, they can look, but they should first make decisions and only look. The reality is that this time of Corona is stressful for all of us. Actually, it gives us a lot of stress for all kinds of reasons. Many of them are justified. But we need to manage our stress, and we need to stress about the things that the stress is going to somehow lead to better decisions, and we need to cut down on the useless stress. And I think, at least for me, and I think for many people like me, stressing over what's happening in the stock market is not going to be helpful. So it's very tough to give advice by saying don't look and don't make decisions. But in this case, I think it is the right decision. So this is going to be a long haul. It's going to be a while before things are back to normal. And I wish us all the calmness and as much control over our stress as possible in these complex times. All the best for now. Bye.
Okay, thanks everyone. Good morning, and thank you for joining us today. This is Max Thompson, and I'm going to walk you through the first couple of slides. It's always good to hear Dan's perspective, and I think it's a good level set to sort of understand his definition of three types of investors, and I think we all sort of agree with where he was coming from. On the first couple slides, I thought I'd start by reviewing some fundamentals of investing. And as you can see in the first chart, the stocks underpinned in the S&P 500 have created significant wealth over the last 30 years. And we also observe that there's a little bit of cyclicality in the index, and that in the recent past, there have been some noticeable corrections approximately every 10 years. In 2000, it was the dot-com overvaluation with stocks trading at 300 times price to earnings. In 2008, it was the subprime securitization, mortgage securitization debacle, and in 2020, while we're living with COVID. So, these are interesting graphs, and let's take a minute to reflect on volatility. I always find it funny. It seems that volatility has a negative connotation, but in my mind, volatility actually should be considered a good thing. Coupled with a prudent risk framework, volatility actually is one of the main drivers of wealth generation. And therefore, a rational investor should have a balanced perspective on the utility of volatility, and that over time we'll experience peaks and troughs, but as evidenced in the data, stock markets eventually rebound and will continue to generate wealth. And although past performance is not an indicator of future performance, we see a fairly established pattern that investors can get comfortable with as it relates to capital markets and wealth generation. We skip to the second slide. Let's just pause here and recap. Okay, so volatility helps generate wealth, and from a rational perspective, over a defined period of time, capital markets generate significant wealth, albeit with some periods of cyclicality and corrections. So the point here is to reinforce that markets will rebound from a correction. The length of recovery is unknown, but it will happen. So, that's an important starting point. So let's shift to another principle. At BEworks, we firmly believe that investment advice from a subject matter expert is the cornerstone of an investment framework, and that on average, following good advice will help improve decision making. Furthermore, establishing an investment portfolio with a diversified across an allocation of equities, fixed income, and cash in accordance with a stated risk appetite provides a strong foundation for a client's investment journey. Now let's fast forward to March 2020. A global pandemic unfolds. Governments across the globe race to enact lockdowns and temporarily shutter the economy, and capital markets react by shedding value as a result of lower expected cash flow. Rational investor would expect this. So why are we panicking? Well, here's where we start to get interesting. The challenge is that most of us are actually quite irrational. We tend to be somewhat immune to increased volatility in a positive sense. Take myself, for example. In late February, before I was about to go on vacation, I was reviewing my portfolio and was quite impressed by my return on my investments. I thought to myself, maybe I should take some profit on a few stocks. But then I said, if I do that, I'm going to create an opportunity cost and I'm going to miss out on some more upside. A little bit greedy. So, it's interesting. So what happens when the market goes into correction mode? The fact is humans are 2 times more sensitive to losses accumulating, and investors get anxious, as Dan mentioned, and generally take flight to safety, typically by selling their equity positions and moving their proceeds into cash or term deposits as they look for stability. So, and as we think about this in the behavioral economics perspective, these actions are referred to as present bias or loss aversion bias. And these are 2 of the biases that David's going to go explore in more detail. If we skip to the next slide, it's interesting. The internet has been a proliferation and a good thing in many ways. And so it's good for information. But we have to be cautious. And with many investors working from home these days, spending much of their time online, they're getting flooded with information, creating information overload, of which much is actually contradictory. Actively searching for information can lead to illusory superiority or overconfidence bias, where people subjectively believe they know more, that they have more expertise than they actually do. That was the investment client type number 2 that Dan was referring to. Their subjective assessment of their own knowledge is higher than their actual knowledge. And the natural result of this can be increased anxiety, or it can lead to a client potentially having optimism bias. And this is a mindset where that can be the start of poor decision making. So if we flip to the next slide, this is an interesting slide. 87% of investors either do not nor have an advisor, nor they either ignore all or some of the advice. Now we know that 87% of investment advisors are not giving bad advice. There are so many good advisors out there. And I think the premise of this slide is, the result of either ignoring or not taking advice is premature redemptions may have negative impact on the firm and advisor revenues, but the bigger consequence is that it creates a potentially significant loss or opportunity cost for clients who retreat from markets in the trough and buy back in as the peak is rising. And the real issue with this is it can exacerbate their confidence and create trust issues with their advisor. And of course, we all know this is a significant unintended consequence for sure, but we believe it's one that can be avoided. So if we slip to the next slide, I think we'll sort of finish off this investing 101 fundamental principles just by saying, as an investment advisor, if you can help your clients mitigate the impact of these biases on their decision-making in times of material negative volatility, you'll be able to reinforce the value of advice you provide and maintain a strong bond with your clients. And this is where we believe leveraging BE can be a key strategy in your communication strategies or frameworks. And with that, I'm going to pass it back to David.
All right, thanks, Max. We've talked about behavioral economics. We're going to go into a lot more detail on it. The index charts that Max put up there were a good visible image describing where we are. But of course, the important question is what's next? And the funny thing is we've been here before, right? I had just started in financial services when Black Monday happened in October '87. Still conflicting views on why that happened. But the markets went down almost 35%, took 3 months to recover. And here I was, a young person just entering financial services. And I went, wow, this is interesting. I also remember 98, at least there we know the cause of that. That was long-term capital management. Markets dropped 22%. There was a bear market rally, W-shaped pattern, but the recovery occurred 3 months later. Then there was 2000, 2003. That was the tech bubble. Broader market took about 3 years to recover. I was on Wall Street during the 2007-2009 crash, which was, as Max had mentioned, the subprime crisis, but it was also a larger global financial crisis. And it took till March 2013 to recover. But then that recovery was part of the longest bull market in history. And it's interesting, right? We've been here before, and we wonder, right? Sure, you've got bears out there claiming they saw this all coming and sold, but some of them said that every year for the 10 years during the bull market. Even a broken clock is right twice a day. But now people are saying, this time will be different. Well, we don't know. The one thing that will be the same is that people's psychological reaction and subsequent behaviors are going to determine the future course of markets, the economy, and society. And that's what we're here to talk about today, behavioral economics. So to better understand behavioral economics, it's helpful to look at some of the foundations of neoclassical economics, and that's rational choice theory. It's really a description that describes humans as homo economicus, or economic man, right? That people are rational, they use all available information, they determine probabilities of outcomes, they accurately calculate costs and benefits of alternatives, and make fully rational choices. We can certainly question some of these assumptions as appearing somewhat unrealistic, but the proponents of rational choice theory say it's really irrelevant if the assumptions are wrong, as long as the models predict and explain behavior. The other side, or a different perspective, is behavioral economics that basically says, we're homo psychologicus, which is we're humans, we're not computers. We're boundedly rational, which means that we try to be rational, but there are bounds on how rational we can be. We also use heuristics and mental shortcuts that help make decisions simpler. We simply don't have the cognitive capacity to fully analyze every single decision. What coffee am I going to have today? And in fact, a lot of these biases are what Dan describes as being predictably irrational. They're so large, they're so consistent, they're predictable, you can actually see it as being predictably irrational. And behavioral economics then looks at these biases and uses nudges to try and encourage better choices. And that's through design of choice architecture, changing the way people see choices. So you can see behavioral economics really is a confluence of psychology and economics. So what are these biases? Biases are things that cause us to behave in a way that does not appear strictly rational according to rational choice theory. And rational here doesn't mean sensible, thoughtful, or predictable. It has a very precise definition and refers to decision-making that's calculating, analytical, goal-oriented, consistent, and even predictable. And these biases spoil all that and cause us to make decisions that are biased in a direction away from what would be considered rational. So for example, as I'm looking at how I'm going to spend my day today or the rest of my day, the rational decision is to go for a run because exercise is good. But present bias, which is a bias towards present, means that I'm going to make a decision, more likely to make a decision that favors present pleasure of relaxing with a book over the future benefit of better physical health. So let's look at what some of these biases are and how they can affect decision making. So for example, decoy effect. People often change their preferences between options when a new option is added. And I'm going to show you a specific example of that in a moment. Confirmation bias, we tend to interpret new information that's consistent with our existing opinion. Loss aversion bias, as Max mentioned, we feel the pain of losses twice as much as the pleasure of gains. That tends to make us more focused on avoiding losses. Illusion of control bias, people tend to believe they have control over random events over which they're actually quite powerless. And finally, representativeness bias. People tend to believe that current conditions will persist unchanged into the future. So that's people saying this, this time's different. And I can remember in 08 and 09, people predicting that the Dow and the S&P and the NASDAQ would all go to zero and companies would be worthless because, the onward trend downward would continue. And we all know that that actually didn't happen. So here was an interesting experience that we decided, our experiment that BEworks ran on 2,000 investors recruited from a personal finance website. So these were people that had a fair degree of interest and knowledge in investing. And the idea here was to see whether some of these assumptions of rational choice theory hold up in the real world. Remember, the idea is that the assumption that we decide like computers may be false, but as long as it describes real world behavior, then that's an acceptable simplification for the model. And here we gave these people a choice of 4 portfolios. And on the upside is how much the portfolio can go up. On the downside is how much it can go down. So essentially you see increasing risk in these portfolios, where risk is defined as the divergence between the maximum gain and the maximum loss, with A being the safest portfolio, D being the riskiest portfolio. And that's really a risk preference, right? You have a preference for coffee, you also have a preference for risk. So when given that choice, we can see that people, 27 picked fund A, all the way through to fund B, 17%. So then the question was, what happens if we change the risk reward profiles by including an ultra low risk, A minus, and an ultra high risk, decoy option? And again, the risk is the range between the maximum return and the maximum loss. The wider that is, the more risk there is. So rational choice theory would suggest that we would pick a risk preference, and that should be stable. Low risk decision makers stay low risk, high risk decision makers stay high risk. And if RCT or rational choice theory is correct, decision makers should be calculating, goal-oriented, consistent, and predictable. And nothing we do should change really how they decide. So we added in this low risk option and removed high risk D, right? Now the choices have changed, but people who prefer high risk should stay in high risk. So what we should see is that the people who had previously picked option D would then pick option C because that's the next available high risk choice. What actually happens is the entire preference shifts leftwards. So rather than fund C becoming the total of fund C and D, so instead of it becoming 50%, what actually happened is fund C is only 18% because suddenly people move downwards in the risk profile. So this says that their preferences shift, and that's contrary to what RCT says. Those high risk people should have chosen high risk, but suddenly when there's a new choice, suddenly they choose less risk. Now the interesting question is, what if we remove the low risk and add a high risk decoy? Is that going to make people suddenly shift their preference towards wanting more risk? I think you can all anticipate where this is going. So we see a similar pattern here. What should have happened is people in A should have piled into B, and there should have been 50% in B. But instead, we can see that people actually move upwards in their risk preference. So that really violates an assumption of rational choice theory. Again, it's not, rational is not the colloquial sensible. It has the specific meaning of goal-oriented, evaluative, and consistent. And rational choice theory is useful, but behavioral economics is actually necessary to understand people's actual behavior. Behavioral economics encourages us to recognize that we are boundedly rational, as Dan Ariely says, predictably irrational. So let's look at the impact of the current investment environment on decision-making, right? So just as we change the decision-making context by putting in an A minus and a D plus, the current pandemic is changing people's investment preferences, and it's due to biases, right? So let's look at behavioral economics in more detail to understand how that's occurring, why it's occurring, and what we can do about it. So 2 factors that are active right now are increased anxiety and scarcity mindset. So people are more anxious. And we know from research that increased anxiety leads to reliably predictive changes in cognitive processing that favor risk aversion and threat detection. People suddenly become aversive to risk and more vigilant in detecting threats. Scarcity mindset describes a situation where resources are perceived to be scarce. People suddenly have diminished capacity for rational thought. And again, this is based on research. This is not based on supposition. And we know now that anxiety is high and resources are perceived as scarce. There's also something called the wealth effect, right? As people's portfolio declines, suddenly they view their wealth as being scarce, and that creates a scarcity mindset. The scarcity mindset doesn't refer to impoverished people. It refers to people operating in an environment where resources are perceived to be scarce. So you can imagine that that will have an impact on investment decision making. Looking first at anxiety. Anxiety reduces prefrontal cortex brain activity and is associated with reduced attentional control. That's lower ability to stay focused and productive. Hyperattentive to threats, so faster responsive and higher engagement with threatening stimuli. Negative interpretations, which is an increased tendency to interpret ambiguous stimuli as negative, thinking the worst. And increased risk aversion. So anxiety leads to more conservative decision-making and risk avoidance. What's the impact on investors? So they have difficulty attending to financial advice. They fixate on checking their portfolio too frequently. They interpret any changes in the market and news as negative. They try to reduce their overall risk and show a preference for lower risk investment options. Think of the previous example where you saw people shifting downwards in risk. And they focus on potential losses rather than potential gains. Let's look at the implications of scarcity mindset. So this causes increased attention to immediate needs, neglecting future needs. It's an intentional shift. And that results in a present bias where people have an increased preference for smaller, sooner rewards over larger, later rewards. There's an interesting experience in psychology on this. If you give children a marshmallow and tell them that if they wait 10 minutes, you'll come back and give them a second marshmallow. The question is, do they eat the one marshmallow or do they wait for the two? Present bias means they eat the one marshmallow and give up the second one. They also have taxed cognitive control, so we see worse performance on challenging cognitive tasks and diminished control over thoughts and behaviors. There's trade-off thinking, which is focusing on opportunity costs or the negatives rather than benefits when making decisions, and heightened self-interest. People prioritize personal gains over pro-social behaviors. And this was a real-world experiment where this was tested. It's interesting because it was a game like Family Feud, and people were given a budget of time per round to answer the question. The time poor group had only 15 seconds. The time rich group had 50 seconds to come up with an answer. They could also borrow time, but they'd have to pay that back through a fee on the next round of winnings. And what the result was that the people who had less time and in a scarcity mindset borrowed at a higher rate and gradually increased their borrowing rates relative to the remaining budget, and their overall performance suffered. Whereas in the rich group, they performed similarly whether they could borrow or whether they couldn't. So that shows that all of those effects described as scarcity mindset actually have real analogs in the real world. What does scarcity mindset do to investors? We see that they have difficulty attending to and processing information related to future needs versus present needs. They miss opportunities to invest because they're hyper-focused on present needs. They have difficulty processing complicated financial advice because it's too cognitively demanding. They take a myopic viewpoint in which they feel they need to liquidate assets to survive now due to trade-off thinking. They focus on costs over benefits. And they're less likely to support charities or invest in pro-social organizations. If we've described all this, the question then becomes, how can advisors help their clients? Right? We have 4 strategies that we're going to talk about today. One is strategies to overcome cognitive limitations, and that's increased memorability. We have another one to overcome the scarcity mindset, which is reducing the present bias. We have another one to overcome anxiety, which is reducing fixation on negative stimuli. And another section will talk about a number of biases and how we can actually correct for those biases in decision making. So let's talk first about overcoming cognitive limitations, increasing memorability. The old expression is keep it simple, stupid. It's so obvious, but why is it not followed? I spent many years marketing investment management products and services. This was before I studied behavioral economics. We always thought that colorful information and lots of information, and charts and graphs would be effective because, according to rational choice theory, these calculating, analytical, goal-oriented, consistent, and even predictable people needed that information in order to make decisions. But behavioral economics actually makes more realistic assumptions. We know that Homo sapiens is not Homo economicus, but rather Homo psychologicus. Our decision-making is constrained by cognitive limitations and time and the information available. And we tend to satisfice, which is make shortcuts that result in suboptimal decisions. So look at all of your communications going out to clients and ask what assumptions are being made regarding the intended audience. Are you speaking to computers or are you speaking to humans who are boundedly rational? What needs to be done is to keep the advice simple and clear, make it succinct, written whenever possible. Interesting research shows that people often think that they learn better through audio-visual or and that they retain more information, but research actually shows the opposite. Print is more memorable. So keep it simple, keep it clear, put it in writing, and don't look at the marketing that I used to do because it's horrible. Let's look at anxiety. We know that anxiety is increased, right? Dan said at the beginning, checking your account encourages you to do something. He's not saying do nothing. He's saying don't do things driven by emotion and impulse rather than careful thought. And research has shown a negative correlation between frequency of account checking and investment performance. That goes the same for weight loss, by the way. Stepping on scales less frequently reduces anxiety and increases weight loss. So what's the first thing your clients see when they log in? Do they see daily changes or do they see reminders of long-term performance and long-term goals? We need to encourage clients to look at their accounts less frequently, commit to a predefined schedule once a quarter. Use long-term gain framing by providing clients with visuals for how the market has recovered in the past to encourage customers to take a long-term view. And focus on the long-term plan. Talked about planned future outcomes rather than current events. Getting clients to commit to checking accounts less frequently and focusing on long-term gains can help overcome the effects of increased anxiety. Let's look at scarcity mindset. What can we do to reduce present bias, right? The idea here is to have people connect with their future self, right? It's this present bias that is most destructive in scarcity mindset. So cue people to think about their future self. What do you plan to do when you retire? How are you going to retire? When are you going to be living? What sorts of things are you going to be doing? What's your hobby? Are you going to travel, right? Make that future self closer to the present self, and then that motivates future-oriented thinking. An interesting tactic, ask investors to write a letter to the future self before making an investment decision. Benjamin Franklin was famous for making lists of pros and cons to consider things carefully because he recognized the importance of being thoughtful and deliberative rather than emotional or reactive. Making an argument to your future self for why you should ignore professional advice and risk your retirement plans is an interesting exercise. We know that professional advice enhances outcomes, and we know that many investors suffer from overconfidence bias. So the objective here is to get people to consider and follow advice. Now we'll turn to some of those common biases that can affect investment decisions. We showed decoy effect already when you put the A- and the D+, how people change their preferences. So that says the way that options are presented is really important. We also talked about confirmation bias, the way people interpret new information to stay consistent with their existing opinion. That also explains why people have a preference for certain news channels. People don't want to hear opinions that are contrary to their opinions. They like to hear opinions that confirm their opinions. So they pick their version of reality and watch the channel that reinforces that. Loss aversion bias, again, people do things to avoid losses rather than rationally to consider losses and gains as being equal. Illusion of control bias, people tend to think they have control over random events when they're actually powerless, and that encourages them to take action when they really shouldn't. That's what Dan was talking about. And finally, representativeness bias, where people think that current conditions will continue on into the future. So let's look at one tactic for overcoming illusion of control bias. Here's where people think that just doing anything is actually going to be helpful, right? So what we need to do is increase the level of participation and involvement by the investor. The investor wants to regain control by acting, even though they have no control. So if they're actually involved more in the investment strategy, that can satisfy their need to act and reduce the likelihood that they'll unilaterally liquidate their portfolio or make an investment decision that's suboptimal. So creating the plan satisfies the need to do anything, but it also increases the likelihood that the plan will be followed. So, there was a great experiment done with pizzas where they put two different groups into a laboratory and they had them both make pizza. Unbeknownst to the participants, back in the kitchen where they couldn't see it, they added significant extra salt to the pizza of one group. They then shared the pizza between the groups and said, okay, how was your pizza? How was their pizza? Well, the people whose pizza was overly salted still said that their pizza tasted delicious because they'd made it. The people who tasted that pizza on the other group recognized the excess salt and said it tasted much worse. So the end result of that is when you're involved in creating something, and Dan's done some interesting research in this area as well that you'll find in some of his books. When people are involved in creating something, they tend to value it more and think it's more worthwhile. So involving people in creating the investment plan will actually increase the likelihood that they'll like it and that they'll follow it. Let's look at another one, enhanced active choice, right? This is where clients feel the need to do anything, whether it's good or not, right? I just think I should be doing something now. I have to do something. A good response to that is let people make choices, right? Give them choices. Why don't you think about the full set of options you can take right now? You can review your investment plan with your advisor. You can liquidate the portfolio and have the opportunity cost of foregone gains. Or you can make a new retirement plan assuming lower income level because you've moved from equities to cash and your income level accumulation rate will be much lower. Therefore, you're going to have less money when you retire. And when people start to see that and look at the trade-offs much more dispassionately, they're less likely to act precipitously. Here's another interesting one called self-distancing. There's theories in psychology called construal level theories where the future tends to be distant and the future self tends to be distant. We often make more rational decisions when thinking about what someone else should do rather than what we should do, also because loss aversion is reduced. So if you're advising someone else, it's not your money, which means you tend to be less loss averse and less irrational and less emotional, and able to then make better rational decisions. So ask people, what advice would they give to a friend, right? If a friend came to you and said, what should I do? Would you tell them to check markets frequently? Would you tell them to try and time the markets? And by the way, we know timing the market, the likelihood of making the right timing. If you were to put $1,000 into the market every year for 30 years and pick one day during any of those 365 days per year, the odds of picking the right day to make that investment over that 30-year period is a 1 in 1 followed by 256 zeros. And it's impossible to even conceptualize of odds that small. In fact, winning the lottery is much more likely than to be able to do that. And no, I'm not suggesting that people buy lottery tickets with their investments, but that puts it into perspective. You simply can't time the market consistently. And finally, would you recommend to your friend, why don't you work with an advisor and follow a plan? And people are much more likely to choose the third one when recommending it to someone else. So then they're more likely to consider that as being a more optimal solution for themselves. Let's look at mental accounting. This is another interesting one. We tend to categorize money into different accounts depending on the intended use. Dan did a famous study on credit cards showing that people with 2 credit cards, let's assume that you have 2 credit cards, one with a $500 balance and one with a $1,000 balance, for example, and you're given an amount of money. The $500 balance card has a low rate, the $1,000 balance card has a high rate. Now the accountant in you would say, put the $500 onto the card with a $1,000 balance because that'll lower your overall interest rate. But what do people actually do? They actually pay off they take the $500 and they pay off the card with the $500 balance. And if you ask them afterwards, well, why did you do that? And their response is, well, then I got rid of one card. I now only have 1 card left. And you can explain to them, well, yes, but your interest is higher. If you put the $500 onto the card with $1,000, your interest rate would be lower. And they'll look and think for a moment and say, yeah, but I only have 1 card now. And that's a perfect example of irrationality, where when we're looking at it dispassionately and analyzing it, you can say, well, that's not rational, but that's how people behave. And you can use that when people look at their investment portfolio as well. So people often say, well, you know, I need money for an emergency, I need to set aside money just in case, but you don't need your whole portfolio for that. What you can do is actually set up a new account, a physically distinct new account, and put a small portion of the portfolio there, say 5% or 10%, right? So if you're gonna need money right away and you're worried about having the money available, put it into this emergency account. That then becomes the account to worry over. That's the account they look at. That's the account they check frequently. That's the account they wanna, you know, sell their equities and buy fixed income or put it in cash, or the reverse. That's the one where they wanna take a big bet. But then what it does is it allows the vast remainder of the portfolio to accumulate in the long term, and there's more comfort in doing that. So let people do mental accounting. Let them separate their current funds from the long-term funds and let them focus on the current funds. Then they're more likely to listen to advice on the long-term funds. So coming back to Dan's statement, right? He said it's very tough to give advice by saying don't look and don't make decisions. But in this case, I think it's the right decision. And you know, there may be opportunities now to make tactical moves. And I'm hearing people saying two opposite things here. Some people are saying, you know, we're at the bottom, it's time to buy. Others are saying, you know, we're going to have a classic W bear rally. We haven't tested the bottom yet. We've got another 10% to go before we test the bottom. You know, those opportunities may exist. The point we're trying to make is that what we need is for investors to make rational decisions by consulting with experts to help them make more normatively optimal investment decisions. And we know, for example, look into your account frequently is going to do the opposite. In conclusion, investors are predictably irrational. Their biases, the effects of anxiety, the effects of scarcity mindset, all of those are so real and so measurable and so predictable that we know they're going to impact investors. Right? That anxiety and the scarcity mindset are compounding what are already existing heuristics and biases that years of research has shown impairs investment decision making. So we have a bit of a perfect storm going on right now. We already have these heuristics and biases, but now we have it all compounded by increased anxiety and increased scarcity mindset. And a lot of what we were talking about today was tactics within behavioral economics that can help us overcome that. We only touched on a few because there's simply not time in an hour. There's literally hundreds of biases that can affect investment decision making. And there's hundreds of ways that anxiety and scarcity mindset can affect investment decision making. But what we've been trying to propose is that behavioral economics offers a way to understand why people are making these normatively suboptimal decisions. Behavioral economics also informs strategies so that we can develop new strategies and new tactics to encourage people to consult their advisor. And as Max said at the beginning, 87% of investors in a recent study we did either don't have an advisor or they ignore some or all of the advice of the advisor. And that's really the statistic that we need to change. That's the statistic we need to move. We need to have more people having advisors, and we need to have more people listening to the advisors. And you know, that research also shows that when you use behavioral tactics, you increase satisfaction, you increase trust, you increase the probability of people listening to the advisor, and that improves outcomes for both investors as well as the advisor. In the most simple terms, you know, what we need to do is we need to keep information simple. We need to mitigate the effects of anxiety. You know, we gave some tactics for that. We need to mitigate the effects of scarcity mindset. We gave some tactics for that. And we need nudges to overcome those common biases. And again, easily 8 to 10 come to mind that are active right now. We really focused on tactics to overcome loss aversion and illusion of control. But for all of those biases, there are tactics that can help investors overcome those biases. With that, I'm going to pass it back over to Max, who's going to talk about some of the things we can do to help you accomplish what we've talked about. Max?
Thanks, David. We realize that there's quite a bit of information here to absorb, and we hope we achieved our goal of being thought-provoking and to help you start thinking differently about your client relationships, and that by leveraging behavioral economics, you could potentially add a strategic dimension that will greatly improve how you listen and communicate with your clients. We've got two solutions that we'd love to continue to talk with you about after the webinar. One is the first valuable step you may want to consider is having BEworks undertake a communications audit. This will allow you to evolve your strategic communications framework with a BE lens, including everything from redesigning your marketing collateral like client statements, letters, emails, messages, helping advisors and call centers with scripts and how to effectively communicate explicit messages with your clients, as well as an optimization of your digital platform and presentment of information. As David said, ensuring clear, simple communications will be one of the most effective things you can do. If we go to the next slide, one of the other tools that we've developed is an advisor coaching training program. The objective of this program is to immerse yourself in the foundations of behavioral economics with the objectives of delivering advice, understanding more biases impacting your business and your clients, helping clients achieve and maintain a long-term focus, get out of that present and scarcity mindset, and how to be an effective advisor. This is really pertinent these days because who knows what's going to happen post-COVID. There's going to be a new normal. We're not going to go back to the same normal. How do we be an effective advisor in a remote or a hybrid scenario going forward? So the last slide, we just wanted to take an opportunity again to thank you for joining us. We hope it was thought-provoking. We hope we get to continue the conversation. We've noticed during the webinar, we've aggregated a lot of questions. We'll try to attempt to answer those questions. We'll also we have recorded the webinar. We'll be providing a summary of the slides and the recording. You can always get a hold of us at info@beworks.com. We look forward to continuing our conversations with you. We look forward to collaborating with you in the future. We truly believe in investment advice is the greatest thing for clients and their investment portfolios. And thank you again. Have a great day. We'll talk to you soon.